Topic 4. Industry Structure Analysis. Industry structure analysis is a fundamental component of strategic management that enables organizations to understand the competitive dynamics, profit potential, growth opportunities, and risks within industry. For Chief Financial Officers, CFOs, industry analysis provides a foundation for strategic planning, capital allocation, investment decisions, mergers and acquisitions, business model design, and long-term value creation. Leading CFO development programs emphasize that modern finance leaders must possess a deep understanding of industry economics and competitive forces to effectively support enterprise strategy and business transformation. Industry structure refers to the underlying characteristics that determine how firms compete and how profits are distributed among participants within a market. While individual company performance is influenced by management quality, operational effectiveness, and innovation capabilities, industry conditions often establish the boundaries within which competitive success can be achieved. Therefore, understanding industry structure allows executives to identify attractive markets, anticipate competitive threats, and position their organizations for sustainable advantage. The most widely used framework for industry structure analysis is Porter's 5 Forces model, which examines 5 critical forces that influence industry profitability. Competitive rivalry among existing competitors, threat of new entrants' bargaining power, of suppliers' bargaining power, of buyers' threat of substitute products or services. The intensity of these forces determines the attractiveness of an industry and its long-term profit potential. Competitive rivalry evaluates the degree of competition among existing firms. Industries characterized by numerous competitors, slow growth, low differentiation, and excess capacity typically experience intense price competition and lower profitability. Finance leaders analyze competitor performance, market share trends, cost structures, and strategic positioning to assess industry competitiveness and identify opportunities for differentiation. The threat of new entrants examines how easily new competitors can enter the market. High barriers to entry, such as significant capital requirements, economies of scale, proprietary technology, regulatory restrictions, strong brands, or customer switching costs, protect existing firms from new competition. CFOs frequently assess entry barriers when evaluating expansion opportunities, acquisitions, and strategic investments. Supplier bargaining power reflects the ability of suppliers to influence pricing, quality, and availability of critical inputs. Industries dependent on a limited number of suppliers may face higher costs and operational risks. Effective industry analysis helps organizations develop sourcing strategies, supply chain resilience, and partnership models that reduce supplier dependency. Buyer bargaining power measures the influence customers have over pricing and industry profitability. Large customers with significant purchasing volumes can pressure firms to reduce prices or increase service levels. Understanding customer concentration, purchasing behavior, and switching costs helps organizations strengthen customer relationships while protecting margins. The threat of substitutes evaluates alternative products or services that satisfy similar customer needs. Technological innovation frequently creates substitutes that disrupt established industries. Digital photography disrupted film. Streaming services transformed entertainment, and fintech solutions challenged traditional banking. Strategic leaders must continuously monitor emerging substitutes and adapt business models accordingly. While Porter's framework remains highly relevant, modern industry analysis has expanded to include additional dimensions. Digital transformation, ecosystem competition, platform business models, sustainability pressures, geopolitical risks, artificial intelligence, and regulatory complexity increasingly influence industry attractiveness. Traditional industry boundaries are becoming less distinct as organizations compete across interconnected ecosystems rather than isolated sectors. For CFOs, industry analysis directly supports strategic resource allocation. Understanding industry economics helps determine where capital should be invested, which markets should be entered or exited, and which business units deserve priority funding. Industry insights also improve forecasting accuracy, risk assessment, valuation analysis, and investment appraisal processes. Industry structure analysis is particularly valuable during mergers and acquisitions. Beyond evaluating target company financials, CFOs must assess the attractiveness of a target's industry, future competitive pressures, regulatory trends, and long-term growth prospects. A financially strong company operating in an unattractive industry may offer limited long-term value creation opportunities. The analysis also supports business transformation initiatives. Organizations undergoing digital transformation must understand how technology is reshaping industry economics, altering customer expectations, reducing barriers to entry, and creating new competitive threats. Industry analysis helps leadership teams identify emerging trends early and adapt strategic priorities accordingly. The Global Competency Framework highlights strategy, market understanding, business models, macroeconomic analysis, and ecosystem management as critical business competencies for finance professionals. Finance leaders are expected to evaluate external environments, assess competitive dynamics, identify opportunities and risks, and provide strategic insights that influence enterprise decision-making. At advanced and executive levels, CFOs must use industry knowledge to shape strategy, anticipate market changes, and guide organizational transformation. In today's rapidly evolving business environment, industry structure analysis is no longer a periodic strategic exercise, but a continuous leadership capability. Organizations that systematically evaluate industry forces, anticipate disruption, understand ecosystem dynamics, and align strategic investments with industry realities are better positioned to achieve sustainable growth, competitive advantage, and long-term enterprise value creation.